Hello, welcome back to a weekly market recap here with Knight. Let's get to it. So this past week, we saw the S&P up 3.97%. We're still down year to date 18.15%. And the NASDAQ, we were up 2.24%, still down year to date 29.04%. What happened over this past week was the continuation of earnings and looking forward to the Fed meeting, which is next week. But let's get into the market and see what happened. When we look at what happened over this past week, we see a pretty solid run up for the first half of the week. Earnings started to come out and they were a little bit worse than expected. Sell off in the middle of the week and then a rise for the end of the week. In the earnings call, and a lot of these earnings calls, and again, the biggest ones were this week. So Apple, Amazon, Microsoft, Meta, Snapchat, a lot of the giant tech companies all reported earnings this week. And it really showed what we've been seeing across the board right now of the market as a whole is slowing in some capacity, but there are certain companies that are weathering the storm better than others. So if we take Apple, for example, Apple still somehow came closely in line with expectations for the market. They had good guidance going forward, and they actually did extremely well this week. Investors, Wall Street really loved their earnings call. Contrast that with Meta. So Meta was really bad earnings call. Basically, the street was hoping they were going to slow expenses, see a way to try to increase margins. And we saw the opposite. Meta basically said, look, even though we're losing top line revenue because we're an ad service company, and as we're in a recession, ad spend really goes down, we still really believe in this metaverse, and we're going to continue spending a lot of money in innovation labs and moving forward. That storyline led to a massive sell-off, about 20% the day after earnings came out. So we've been seeing a huge bifurcation between some companies. And then ExxonMobil came out this week with almost as much quarterly profit as Apple had. So they just were extremely helped by the high gas prices and have one of their most profitable quarters. Now, aside from all the big earnings, which overall the entire earnings season has been better than expected. So not a smash it out of the park for all companies, but it hasn't been as dire, and it's actually helped lead the stock market over the past 2 weeks to some pretty significant rallies. We've rallied almost 8% in the S&P, and we've rallied close to 9% in the NASDAQ, even with some of the biggest misses being in tech. So overall, earnings are driving the market in a positive way right now. And we actually got some good news on the GDP front. So for the third quarter, the preliminary analysis shows that we actually had positive GDP growth. So we had quarter one, quarter two of negative GDP growth, and now quarter three of positive GDP growth, which we still have not technically defined the first 2 quarters of this year as a recession, but having the third quarter be a positive growth for GDP, if that is continued going forward, there's a possibility that we already might be out of the recession. Now, a lot of analysts and Wall Street and investment advisors are thinking that 2023, there's a high likelihood that second half of 2023, we're actually going to see the real recession. We haven't felt like we're in a recession yet because we haven't seen big job losses. We haven't seen all that. That still could be coming in 2023. So we're by no way out of the woods, but some strong economic data coming out. So 2 reasons to help the market go up a little bit. Now, here's a third reason. We're getting to the point where the Fed has already done a significant amount of their tightening. Even right now, they're at 3% to 3.25%. Our expectation is next week, they're definitely going to hit us with another 75 basis point increase. So 3.75 to 4% is going to be what the federal funds rate is at. And then our expectation is that in December, they're going to do another 50-point raise, which will bring us to 4.5%. The reason why that matters is the tightening right now is getting to a place where we've seen different parts of the yield curve invert. And the one that Jerome Powell cares about the most, everyone talks about this 10-2. Oh, the 10-2 and we're in a recession. Jerome Powell doesn't really care as much about that one as he cares about the 10-year treasury compared to the 13-week treasury. Now, that one just inverted for the first time, which means that now the 13 weeks you're getting benefited by having a higher interest rate for a 13-week treasury than holding a 10-year treasury. So way out of balance, but it might be a sign that the Fed has actually done enough tightening. And when the Fed has done enough tightening, they can start to relax. Now, the market has seen this part of it too. So you have three real catalysts for why the market has performed well over the past week. Now, we're going to get the Fed come out next week and give us their most recent meeting notes. Jerome Powell's going to come out and speak, and we're going to get another assessment as to where we are. We're going to start getting some new CPI readings. So a lot more data shall be coming out in the next couple of weeks. But in this kind of shorter period of relaxation without any big data-driven points, we've actually seen the market start to perform relatively strongly because of, again, those three items. Earnings not being as bad as we were afraid of, GDP coming in a little bit higher, and the realization that the Fed's done most of their tightening. Now, they might keep it there for a while, but the major catalysts are starting to work their way through the market. Instead of all the uncertainty and fear, we're starting to have a little bit more clarity. So hope that clarifies for you guys why the market has performed so well this past week. And as always, we're here to support you. Your mind's here to support you. We'll see you again next week.